Hello, this is Lisa Sretanovich, the Velocity Detective. I am a Hi, I'm Lisa, the Velocity Detective. I'm a CPA that volunteers with Texas accountants and lawyers for the arts. Today we are going to be talking about tax deductions. Ooh, so exciting. But before we jump into that wonderful topic, let me tell you a little bit about Texas Accountants and Lawyers for the Arts, TALA. Not only does it provide educational material like what you guys are going to learn about today, but it also allows you as an artist or a nonprofit organization that supports the arts a way to connect one-on-one pro bono with an attorney or an accountant. Why would you even want to do this? Well, if you're an artist, maybe you want to form a limited liability company. Maybe you're a nonprofit organization and you want to create a contract and you want an attorney to look that over before you put it out there. Maybe you need your chart of accounts set up. So there's a lot of ways that you can utilize TALA rather than just learning stuff, actually implementing it into your organization. The best way to get a hold of them is to go to their website, talaarts.org. You can also email them at info@talaarts.org. Remember that, again, we have a lot of really great opportunities for you to utilize the resources from TALA. Tax office hours are one of those ways. Both myself, I'm a CPA, and a couple of other CPAs are going to be there. We can answer questions for you just on the fly. So if you're doing your tax return and you've got a question you're stuck about, is this deduction something that I should put in line 19 or in line 20? Then we're there for that. If you're not really sure about, Lisa said something in this webinar, and I want to make sure I understand how to put that into my tax return, we can help you with that too. We can't actually do your tax return for you, but we're there to answer all your questions. Now let's go back to the idea of being a member of TALA. If you are an individual artist, it's $75 a year. That's super cheap and affordable for most everybody's budget. Now there is an income threshold which you have to be under in order to qualify, but it's like 3 or 4 times the annual poverty rates. All those things are on TALA's website, and you go check them out and see whether or not you qualify. If you don't, make sure that you sign up for their keep us informed thing, like their newsletter. That way, when things like these tax open office hours pop up, you'll get a reminder that those are coming up. So make sure to sign up for that too. One of the best ways to do that is to scan this QR code or go to the link at the bottom of this screen. That will give you the opportunity for 2 things. First of all, it will allow you to download a PDF of these 100 tax deductions that we're going to be going over today. So you'll have it right there in your back pocket. The other thing it will allow you to do is just pop right over to TALA and sign up for that newsletter. Or you can just sign up for TALA, right, and become a member. But at very minimum, get on their mailing list so that you can get the information that you need. And again, pop over right now to just take your device and scan that QR code, or take a screenshot so that you can get that link and download these 100 tax deductions. Now, these are specifically for the tax years of 2025 and 2026, and really focus on artists that are filing Schedule C. While most of the deductions will overlap to other types of entity types like an S corporation or a partnership, these are really focused on the individual artist filing a Schedule C with their personal tax return. Now, if you happen to be live with us on YouTube right now, if you are logged into YouTube, you can actually put a question live while we're here today in the chat. So if you're live with us on YouTube today, go ahead and put questions in the chat, and we'll try to get to those as we go along. We are recording this, so even if you are with us live, you'll be able to see it again on Tala's YouTube channel. So make sure that along with signing up for their newsletter, that you subscribe to that channel. Okay, we're going to dive straight in, okay? Because now we're not going to go over every single 100 of these deductions. We're going to go over some of the most major ones, and then we're going to do a little bit deeper dive into some in the bonus sections. Those are going to be around meals and miles and home office deductions. So stick around to the end so you can dive a little bit deeper into those. First of all, we're going to really think about why we even have tax deductions, all right? So first of all, in order to even qualify for deductions, you have to be a business. And what does that mean? Well, the IRS says that in order to be a business, you have to exchange goods or services. So for a musician, that would be singing a gig or selling a song. Exchange goods or services for compensation. Somebody actually has to pay you. So if you find that your screen is frozen, like with a spinning circle, maybe you can log out and log back in. I see that you've already tried refreshing. Can somebody else confirm that they can actually see and hear me out there? Meanwhile, we're going to go back to what it means to be talking about a business. You have to be a business in order to take deductions. You have to exchange goods or services for compensation. So you have to be paid. Now there's bartering. So if you trade singing at your best friend's 8-year-old daughter's birthday party, and they're going to give you some web design, that's a barter exchange. So it's still an exchange. But you need to make sure that the exchange is with the intention to make a profit. So even if you haven't made a profit yet, and a profit is when you have more money coming in than going out, you still, if you intend to make a profit, then we are considered a business. If you don't intend to make a profit, then you are a hobby and you don't actually get to take deductions. So you still have to claim the income, darn it, but you don't get to claim the deductions against it. So if you're a hobby, this is not for you. Once again, if you are an S corporation or a partnership, many of these expenditures still apply to you, but there are some nuances that we are not going to address in this particular webinar around those differences. So I would say stick around because most of them are still applicable, but there are some nuances if you're an S corp or a partnership that are a little bit different. The very first thing, if you are a business, is that you truly want to separate your finances. That's both in order to protect your personal assets and to make the reporting for taxes much easier. So have a separate business type bank account, not just a personal account that's segregated and say, this is what we're going to use for business. Make it an actual business bank account, a business type bank account. The next step on whether or not the expenditure, whether or not the IRS will consider it a valid deduction, is whether it is both ordinary and necessary. Now, every art business is different. A musician may have an ordinary and necessary expenditure, like a ticket that they have bought to a concert because they're going to do research on that new genre. That would be ordinary and necessary for a musician, but that same ticket would not be ordinary and necessary for a sculptor because they wouldn't be doing research on new music genres. So ordinary and necessary, they have to be both. The third rule is the math. Remember I said that the income coming in minus those expenses going out, those expenses give you that smaller tax bill. That's fantastic. So we want to make sure that we really focus on what is ordinary and necessary for your type of business, as well as making your tax bill just a little bit smaller, and that you are not a hobby. Remember that if you are not a hobby, you only pay tax on what you make, that income, and you do not get to take any expenses to lower that amount that you're going to pay taxes on. There's a question about whether or not we'll be sharing the slides. We may, through Tala, especially if you sign up for their newsletter, send a link out that have the slides a little bit later. Right now, though, again, you should grab the list, the PDF list of all of these 100 tax deductions. First of all, it gives you all of the names of the tax deductions in alphabetical order, and then it tells you what line item on Schedule C that type of expenditure would apply. We're also going to talk about the different types of areas within your business, the divisions within your business that these expenditures would apply. The reason we're going to talk about these different divisions is when you are running your business, you want to think about spending money not to get a tax deduction and lower your tax bill. We like that, yes, but that is not the main reason that we are in business. The main reason that we are in business is to exchange goods or services for compensation to make a profit. And why do we even want to make a profit? So that we can put it in our back pocket, right? So as we're thinking about that and the whole idea of making a profit, we're going to align a lot of the thought process around why we have these expenditures in the first place with which division they align. If that expenditure helps operate these divisions and enhance these divisions, then we know that we are on our way to actually making a profit. Thank you. I can see that we are being seen and heard out there in the big bad world. So thank you for letting me know all about that. Again, we're going to align these expenditures with both the Schedule C, which line item on the Schedule C, and which division they would most likely go to. And I will let you know that there are a lot of expenditures that, depending on what it is you're doing with that expense, it could actually go into more than one division. That's really cool because you can really use an expense in a number of different ways to make sure that you are in it for a profit. So that's pretty exciting. There are actually two sides to the Schedule C. The first page of Schedule C is where all of the expenses are going to go. They're going to be down here in Part 2. And but a little bit of what we're going to talk about, especially with regards to miles and other expenses, is going to be on the second page. If you do not have inventory, then the cost of goods sold section is not relevant for you. Lisa, what do you mean by that? Do I have inventory or not? Well, there's a special provision for artists and creatives and some new rules with the new 2025 released rules that say that if you have under a certain threshold, used to be $10 million in gross revenue, now I believe it's 25 million, that you do not have to keep inventory. And on top of that, artists don't have to keep inventory at all. So the reason that that's pretty exciting from a tax deduction perspective is that instead of your canvas and your paint and all of the things that you buy that go into your art not being expensed in the year that you bought it, that's what cost of goods sold does. Instead, it expenses it in the year that you sold it. So you buy the canvas and maybe it costs you $500 in 2025. If you don't sell that piece of art until 2027, well, you don't get to take that expense until 2027. That's what cost of goods sold does in inventory. The great thing is now we call those, for artists, supplies. It's much easier to keep in your brain. It's much easier to keep in all of your bookkeeping, and you don't have to deal with, well, I don't remember how much I paid for this particular piece of canvas and how much actual paint went into that art 3 years down the road. You don't have to keep track of all of that. It makes it really, really streamlined. So I love that about not utilizing the cost of goods sold section and just expensing those as supplies when you actually purchase them. The next section is all about your miles and utilizing your personal vehicle for business purposes. This is how you're going to track some of these things. And so what I want you to do is on January 1st of every single year, I want you to march yourself out and take a picture utilizing your device, that's fine, of the mileage odometer so that you've got a record of that beginning miles. Why do you care about that? Well, the second part says you have to know how many miles were business of your personal vehicle that you drove, how many miles were business, how many were commuting, and how many were other. The other is all of those personal miles that you drove. So let's say that you are an artist, you're a musician, and your younger sister, Harmony, wants to go to the park. So you grab your guitar and you go to the park with Harmony. Is that personal or business? Well, it was really to take your sister to the park. So that's a personal explanation of those miles. Those would go in other. And you have to be able to identify those. And as a percentage of the total miles, you have to be able to tell how much were business. So knowing what your miles are at the beginning of the year helps you make sure that you know what percentage those miles are if you do the more advanced version. Either way, you want to make sure that you have that documentation. Thinking about documentation and mileage, the IRS requires you to keep a log of all of your miles. And then it says down at the very bottom of that section, did you keep a log and is it in writing? You don't want to say yes and then no. That's kind of going to be a little flag to the IRS that says, you didn't do your job. The other thing you don't want to do is say yes and not actually have done it. The log information must be contemporaneous. A big IRS word, contemporaneous documentation. What that means is it has to be at the time that the expense was incurred. So you can't go back, if you were ever audited, you can't go back 2 years later and try and recreate something, all right? It has to be logged at the same time. Then part 3 is all about the other expenses. And as it turns out, a significant portion of most artists, most musicians, most painters, in fact, most entrepreneurs, a lot of their expenditures are in these other expenses. And you need to be able to put those into kind of buckets so that you don't have this super long list of other expenses. You don't have to have one for each line, for each expenditure that you've ever had. You can actually put them into buckets that are a little bit more, where you can only have like 7 or 8 instead of just listing everything that you have, right? So for example, bank fees and merchant service fees. A lot of us might pay $15 a month to have a Chase business account. Well, that would go under bank fees. You could also, if you use Stripe or Square, you're going to have fees that are associated with those. That can go all under bank and merchant service fees as one line item. It doesn't have to be all separate. Our first division is going to be operations. Operations is really what you actually do and where you do it. So it's kind of like your headquarters for all of what you do. Insurance is one of those things that we would want to potentially have to protect our operation. And you might have equipment insurance, you might have insurance if you're a musician that you're going to go to an event, you might have a very specific insurance for that. You might have just general liability insurance. As long as it's not health insurance, it goes in line 15 on Schedule C. Again, we're going to go back to our page 1 of Schedule C, and it would go on line 15. Now, I did it in this order so that your brain could kind of wrap itself around what it is you do and what kind of expenses that you are paying already for your business. Instead of going line by line for the tax return, let's think about it as how you're operating your business, and then we're going to back into the tax return. So insurance is a great example of an expense that you would have for your operations. Of course, rent. Now, rent is a storage facility, not rent of your apartment. This is rent that is outside of your home office. Home office is going to be a completely separate topic that we'll cover. But renting of, now maybe you do rent a studio. If you rent a studio space, ATX Theater has a lot of really great priced rental spots that you can rent out for your dance group. That would be an example of what you would put in the rent category. If you rented some equipment, I have a ring light in front of me right now so that I can just look pretty for you guys today. But if I really wanted to rent out a lot of recording equipment and make this like a really great production, and I rented a ring light and some cameras, that would be an example of equipment rental that you might put in equipment. And then there's equipment repairs. Now they go on 2 different line items on Schedule C, but that maybe, okay, so if I owned my own ring light and I needed to repair it, I needed to, I don't know, one of its little legs broke and I repaired that, that would be an example of an equipment repair. They are 2 different line items on Schedule C, but you see how both of those are related to how you operate your business. Things like freight and shipping and office furniture are also in your operations. Now think about office furniture. There's a really cool piece of this called Safe Harbor. If you do not elect out of Safe Harbor, then you can deduct up to $2,500. That's $2,500 for each piece of furniture. We're going to talk about Safe Harbor in a lot of different areas. So keep in mind that it is $2,500. Now it's for each piece that you buy. So you see this desk chair behind me? If that cost $2,500 and I bought two of them, even though my receipt said $5,000, because they're individual items, it counts as two at each item is at or under $2,500. If it's above that, then you have to capitalize it and you have some depreciation, and that's like a whole other webinar that we need to talk about. But that safe harbor, it's $2,500 unless you elect out of it. So you have all the way up until then, and that's going to help lower your tax bill. In operations, we also have a lot of things. The biggest one we sort of already talked about when we talked about, instead of using cost of goods sold, we're going to put all of the things that we use to do our craft, we're going to put those in supplies. Those go on line 22. So instead of using cost of goods sold, we're going to put all of those types of expenditures on line 22, the supplies. Now, those are different than office supplies. Office supplies go in office expenditures, all right? So it's two different lines. So there's two different types of supplies: office supplies and the supplies you use to actually do your craft. Then we've got travel, meals, and that sort of thing. I put them in operations, although they could go in a number of different divisions. All right, we're going to talk about operations first so we can give you an idea of how to think about them. And then I'm going to switch over real quick to some other areas, right? So here you are, and you are like our friend Melody, who is a blues singer. She's got a gig in Oklahoma. Well, she's in Texas, and when she travels for this gig, she's going to have to fly there. So she's got airfare, and she's got a hotel because she's going to spend the night. So because she's spending the night, she can also deduct the meals when she's traveling. Now, some new rules have come out around meals when you are traveling. And if you don't have substantial rest, that usually means you're going to sleep overnight, okay? You're going to get a hotel room. If you don't have that, then you actually can't deduct that meal that you had. But Lisa, let's say that she's from Dallas and she's driving up to Oklahoma instead of flying, all right? She drove up there. It's a 6-hour drive, and she performed. It was a 4-hour performance, and then she drove back. So even though she had like an 18-hour day, because she didn't have that rest period, those meals, even though she had to have lunch and dinner, they don't actually count. Not for travel meals. Now, this is kind of new, and so I want you guys to write that down. You have to have that substantial rest period in order for travel meals to actually be deductible. On the other hand, let's say, and this is kind of a tip, all right? If she goes up there and she has this gig, while she's there, she decides that she's going to go out to dinner and take out a music supervisor that she wants to talk to about potentially sync licensing her music. That becomes a marketing meal, and that now is a tax deduction. So you can mix and match like that across your divisions, and that will give you a really great opportunity to get that tax deduction, even though in and of itself, that meal wasn't deductible. So that's like a little tip for you there on how to make it a tax deduction for your business. Other things that I really want you to think about in your operations are your internet and your cell phone. Yes, almost every one of us have to have one of these devices. And the IRS says, well, I understand that if you have one, we're going to give you a little bit of a deduction, but we want to make sure that it is just the part that you're using for business. So I only have one device. I have six different businesses, and I use it for my personal stuff. I FaceTime with my grandkids. I call my mom. I talk to my best friend. So the IRS says, we know that you're going to use that at least some of the time for personal. So you can't claim all of it for business, neither your internet, even though we know that a significant portion of it is going to be for business. You can't claim the whole thing if that's the only internet you have. So internet and cell phone, those would be based on a percentage. That percentage is, there's no bright line test for that in the IRS codes. You kind of want to make sure that you don't overdo it, like, because the IRS knows you're going to use it for personal. Maybe do 50% business, 50% personal, unless you can otherwise document that. Now, we talked about the vehicle use earlier. This is if you have a personal vehicle that you own personally, you purchased it from the dealer or from some guy on the street, and you own it or are paying a lease on it, or you have a loan, but it's in your name, but part of the time you use it for business. Like when Melody went up to Oklahoma, she used her personal vehicle. For that, you need to make sure that you capture your mileage in that log that we talked about. On a separate line, you can have parking and tolls. So a lot of the times I'm seeing, well, Lisa, everybody tells me that I have to keep all of my receipts. And for mileage, if you are going to utilize the miles, the mileage reimbursement dollar percentage, then yes, you do. You don't have to. But one thing I want to caution you about is keeping those expenditures for the gas. Like when Melody went up to Oklahoma, she tracked the miles, but because she's going to use the simplified method, she's not going to use the actual method. She's going to just use the percentage that the cents that the IRS says for the year, and not actuals. If you use actuals, you don't say that there was $20 for gas for this trip. You have to use as a percentage of your total expenditures. So yes, you have to capture all of those receipts, but you don't put that $20 on your tax return. The parking and the tolls, on the other hand, are very specific to business, and that you get to put the actual. So you want to keep those specific receipts. It's a little confusing, and we do have a bonus slide on specifically on auto. So we're going to jump now to the home office, which we also have a bonus slide, because it's also a little bit confusing, right? With your home office, it's a little bit the same way. You have either a percentage of the square footage of your dedicated workspace in your home, and then you have to keep track of every single item that you spend on your house. Your rent, your mortgage interest, your insurance, your taxes, your all of these things. And then based on a percentage, you get to take that deduction. Or you can do the simplified version, which is you take that dedicated space that you have, that you use to make sure that you either 100% you're doing your business in your home, Or maybe let's think about if you do have a space that you rent out for your studio. Maybe you go to your studio sometimes, but you do all of the accounting and your bookkeeping and your strategy at home. So from the 6 divisions perspective, you would do your operations at the studio, but all of the rest of the divisions you do at your home office, then that still counts. The simplified version is you take that square footage and you multiply it by $5. We'll get a little more into that on the bonus slide. But let's think about some other more specific things like dry cleaning. This is going back to, you remember at the beginning I said that every business has to think about what is ordinary and necessary for their specific business. Well, maybe I am a CPA and I have a suit that I like to wear. It's blue and I go get it dry cleaned. Well, just because I have a suit and I like to wear it as a CPA doesn't make it ordinary and necessary for my business. However, if I am an actor, then my costumes would be part of, I can't be the actor without the costumes. So that dry cleaning cost for that actor would absolutely be a deduction. So just because one type of business gets to deduct a type of expenditure doesn't mean that you will on for your specific industry. That's a little bit of a hard one to get your head wrapped around, which is why I put the idea of costumes in there. That comes back to costumes are part of an actor's wardrobe that they have to have. But if I'm not an actor, I don't get to take costumes themselves, much less the dry cleaning of those costumes as a deduction. So the idea of a uniform, unless it has a logo on it, like when you worked at McDonald's when you were 16, right? They had the McDonald's logo on their little polo shirts. Well, that would be a very specific deduction that you could take for your operations. Actually, I wouldn't put that in operations unless you're McDonald's. Maybe it's more of in your advertising. So maybe marketing and sales division would be your logo shirt. You have a systems division. Your systems are all of those things that your operations is what you do, systems is how you do it. And a lot of the times we have hardware and software that helps us do our business. So that would be like your computer and your laptop, assuming that they are under that threshold of $2,500. Then you could just expense them, and all you have to do is put them on your Schedule C. If you've got repairs or tech support, again, that would be on your repairs and maintenance. Your information technology, that's going to be all of your applications, the software subscriptions that you get. I have a lot of confusion oftentimes with what a lot of people see, dues and subscriptions. Your software subscriptions to Adobe or Acrobat or QuickBooks, your software subscriptions are not dues and subscriptions. So I want you to be very clear about that. And information technology is one of those line items that goes on line 27B, which is those other deductions. So you see how we have apps and cloud storage and website hosting. All of those are lumped into this one category that is labeled information technology, rather than having them line itemed out individually. So you can lump them together as long as it's like in a category that makes sense. And It's really important that you understand that information technology is on that other line item. You're not going to find it up in the top part where there's actual lines that go with it. So now let's talk about website design. Earlier we talked about, like barter situations. Well, if you barter for that website design, then you're going to have income for the exact amount of that design. And you would want to show that you actually spent money or you exchanged that barter. So you would want to put that in contract labor. Now, a lot of the times, the items in contract labor, you would want to think about giving somebody a 1099. So you need to make sure that you keep your records. If it is barter situation, then you would not give them a 1099 NEC. But you see how web design would be in that contract labor. There's a lot of other areas that might have a need for that contract labor. And that could be in another division. So if you haven't already done it, make sure that you grab that the 100 tax deductions so you can see what other what other things are out there, and kind of what line item they're going to apply to on Schedule C, as well as what division that they might be applicable to. In addition, grab that sign up for TALA to get their newsletter, to make sure that you get in their list so that you can make sure that you don't skip things like these upcoming tax, where you can actually come and say, hey, is this deduction, do I have it in the right place? Can I actually take this deduction one-on-one with a CPA? The next division we're going to talk about is finance. And that's maybe where if you pay for somebody to do your tax return or to do your bookkeeping for you, or you pay somebody, a lawyer, to look over some contracts for you outside of TALA, that's where your professional fees are going to come into play. Professional fees are only accountants and lawyers. So it's not if you pay somebody who says they're a professional to maybe a professional voice coach. Well, a voice coach would be in operations, yes, under contract labor, but not a professional fee, even though they use that word professional. Some other things that you might have in your finance division is permits. So if you need a permit to play your gig on the corner of 6th and Congress, that would go in your finance division. Copyright fees. This is huge for writers and musicians. Copyright fees, your limited liability setup fees might also be something that you would find in your finance division. And then, of course, we talked already about banking fees and merchant service fees, but also interest on your business credit card. Now, this is an interesting one. If you are using a personal card that you dedicate for business, you actually cannot take the interest charges. If you don't pay it off every month and there's an interest on it, you can't take those interest charges as business expenses because it's a personal card. So that's another reason that you want to have really a separation between your business and your personal, is you want to be able to take that interest as an expense because you had to pay it. It lowered your disposable income. You would want it to lower your taxable income too. Sales and marketing, hey man, that's you getting out there and telling the world about what it is you do. So that's if you have paid ads on Facebook or Instagram, if you have a flyer that you printed, that would overlap into advertising. think about your business cards or your headshots, or if you're going to the farmer's market and they make you pay a fee for that booth, all of that would fall into advertising. And then as you're building those relationships, you remember I mentioned when Melody went to Oklahoma, she stopped and said, "Hey, I want to build this relationship with you, Mr. Supervisor, a music supervisor. I can actually get that meal deduction as I'm building those relationships." A thing to note is if you are giving gifts to your people that refer people to you, or to your vendors, or other people, that you only get to have up to $25 per year per person. So if you give a gift basket and you spend $39 on that gift basket, you actually only get to deduct 25. So I want you to keep that in mind as part of, is it more important for me to give that gift that's $39 because it builds that relationship better, even though I only get to deduct 25? That's cool. You don't make your business decisions solely based on whether it's a tax deduction or not. So that's one of the things I really want to have you really think about is, does it make sense to only give a $25 gift because that's all I'm going to get in a tax deduction? Or is it better for me to spend a little bit more money and build that relationship? We talked earlier about those logo uniforms, maybe being a part of your sales and marketing. That's because you want to get your branding out there. That's where you get that deduction from. Also, if you've got consultants that are helping you, I know that Texas and Accountants and Lawyers for the Arts, we utilize some social media help in order to get our branding out a little bit more effectively. So those kind of consultants, if it is a consultant, even though it's branding, it wouldn't be advertising, it would be contract labor. So because it's a consultant, it would be contract labor. So see, there's different line items that even though it's in the sales and marketing division, it depends on what it is they do for you on how it gets categorized on Schedule C. Your strategy and execution division is really one of my favorites. And oftentimes this is where our dues are going to go. So if you sign up for TALA, this is the division where your dues and memberships are going to sit. If you're a member of the Actors Guild, this is kind of where that would go in again, dues and memberships. Education, if you end up paying for, and this one is particularly free, but if there is a course that you want to take or some coaching that you want to get, conference you want to go to, as long as it is enhancing your already established business, that's part of where this education would go. And that is a tax deduction for sure. Remember we talked about office supplies earlier? Well, you've kind of got to keep this vehicle that we call a business going. This is where your administrative costs would be. So office supplies, postage, printing of documents. Now, those are all going to be on 3 actually different lines on Schedule C, but it's all around the administrative piece of keeping your business going. And it's really important that we think about keeping it going. It's not just about the operations itself. It's not just about making sure that you are able to do your art. It's making sure that you're able to do your art tomorrow and next year and in 2027 and 2028. It's how can we make this vehicle that we call a business actually making money on an ongoing basis, not just one time. Your team division is where you're starting to expand that circle of influence. It has a little bit to do with sales and marketing, so there's some overlap there, but maybe you've got some video production that you want to do so that you're an artist and you play guitar, but you're thinking about doing some online courses so that you can teach guitar. So the video production might be one of your contractors, your subcontractors that you're utilizing in order to expand your revenue streams. So contractors are definitely one of your team members that you want to think about. If you are in a band and you pay your drummer, and they're not part of the owner there, it's not in a partnership, that would be another instance where you would have them as a contractor for you. Maybe you have a booking agent. If they are paid on a commission basis, same with gallery fees, if it's on a commission basis, then the line item would be commissions. Otherwise, it would be in the contractor. If you just pay them a flat fee or something to that effect, then your booking agent would be a contractor. When you're thinking about building the culture of your own team, one of the things that I want to mention, particularly about going into 2026, I mean, we're already a few months into it, is office meals and snacks. If you have just yourself, first of all, you're not an employee of your own organization. S corporations, again, are a little bit different, but today we're talking about sole proprietors filing a Schedule C. This means even if you are a limited liability company, if you are filing Schedule C for your tax return, then you would be classified for tax purposes as a sole proprietor. Office snacks in 2025 are deductible at 50%. In 2026, they have taken that off of the table. So if you buy snacks for your home office, or the only way that those are deductible is if they are available for the general public. So let's say that you have a music recording studio and you put out M&Ms for all of the people that come in. Well, that would be okay because it's available for the general public. But if you have it only back in the employee snack room, the employee kitchen, then no longer is that deductible in 26. In 25 it is, in 26 it is not. So I want you to keep that in mind. Another idea about buying meals and food and so forth. Let's say that you have a gallery reception. So you're an artist and you are displaying your art in a gallery and you buy cheese and wine for that event. That is 100% deductible, as opposed to 50% when we're just talking about meals. Team meals and office snacks in 2026 are no longer deductible. The cheese and wine for the gallery, 100% deductible. Big changes there. Again, if you haven't already downloaded it, make sure that you grab this list of 100 deductions. And we're going to jump to the home office deduction really quick. It has to be your principal place of business. Again, I mentioned earlier that it has to be a dedicated space used exclusively and regularly for your business. Again, you can have a studio somewhere else as long as you regularly do business in that space. The IRS gives the example of a dining room table. You can't use it both for dinner and putting your laptop on after dinner and going to work dedicated. It has to be dedicated 24 hours a day. The simplified method I mentioned earlier is $5 per dedicated square feet up to 300 square feet. You don't have to keep any records at all, and you don't have to worry about depreciation. If you're going to do the actual method, you have to know the percentage of all of your expenditures. You have to keep records for all of them for the whole year. So every single time that you pay rent, you have to have a supporting piece of documentation, all of your utilities, all of your insurance, all of the repairs and maintenance. And you base it on a percentage of the square feet. So if you have a 1,000 square foot apartment and you have a 10 square foot bedroom that you have dedicated for your home office, then you would get 10% of all of those types of expenses in the actual method. The other thing is that each year you can decide which one is better for you. So if next year you moved into a really, really expensive apartment, and even though it's still only 10%, you did all the math and it's better for your tax purposes because it's going to be more than $1,500, then you can switch to the actual method each year. On the other hand, for your miles, once you go to the actual expenses, you cannot switch back and forth. You have to stay with actual once you go with actual. Again, the tracking is very, very laborious. You have to keep track of every single gas. No matter whether it's business or not business, you have to keep track of every single gas receipt, every single time you go and get your car repaired, all of the oil and gas changes and so forth. The easier way to do it is the standard rate. In 2025, it's 70 cents per business mile. And in 2026, it's 72.5 cents per business mile. There was a question about mileage and can they just keep a spreadsheet and then use Google Maps later on? And the answer to that is yes, as long as you fill it out. You have to have the date, the miles, the destination, which you went address to address, and the business purpose. So on your spreadsheet, you want to make sure that you include not just that destination, not just that address, but why you were going there. Was it a gig? Was it to go see your CPA? Was it to attend a TALA event that was in person, right? So you want to make sure that you keep all four of those things. And then we've got our business meals. Again, in 2026, the big change is that office meals and snacks are no longer going to be deductible. So you have to make a decision. Is it really important for me, for my culture, for my business, to have those snacks available? And if so, you go ahead and you spend the money. You just realize that you're not going to get that tax deduction. There are business per diem. And I wanted to make a little note of that because sometimes, especially touring artists, it makes it a little easier because you don't have to keep track of receipts. Keep in mind that even if you use per diem, that you only get to deduct 50%, not 100% of that per diem. If you have that, you're meeting with prospects or clients, or you're meeting with your CPA, those meals are 50% deductible. If you are having a reception or something that is open to the general public, then those meals are 100% deductible. Remember that you're going to want to keep track of all of your receipts. The IRS allows now digital receipts. So a JPEG or a PDF of the receipt is almost better nowadays than using your shoebox to keep everything in, because have you looked at those receipts that come out of the gas thing or even going to a restaurant? In 3 days, they seem to fade, right? Especially if you've crumpled it. I don't know anything about that at all, but if you've done that, then you want to make sure that you take a picture of them or a PDF. So scan them in some way. Once again, I just want to make sure that you've been able to get a copy of these 100 type tax deductions and sign up for TALA. If you've got more questions, I know that there have been some about S corporations. Well, maybe come to one of those tax clinics that we're going to be doing. There's 2 of them that are coming up. So I want you to make sure that you go ahead and sign up for Tala's newsletter to make sure that you attend those. With that, we have hit the top of the hour, and I'm so glad that you were able to run through. I know we didn't hit all 100 deductions, but we came pretty darn close. There's a whole lot of new things coming out, especially as tax laws change all the time. So be on the lookout for the next one of these webinars. Thank you guys, and sign up for Tala's newsletter.